What's up, family? This is your boy Ivan Hall, the Credit King. Do you have a credit card with a high interest rate? Applying for a new credit card and doing a balance transfer might be the best strategy for you to use. A balance transfer involves moving debt from a high-interest credit card to a new card with a lower interest rate, ideally one with an introductory 0% period. Essentially, you're using one card to pay off another, but because you aren't paying as much in interest, you have more money available to pay down your debt more quickly. A balance transfer makes financial sense only if the money you save on interest is more than any fee you'll pay to carry out the transfer. Moving debt to a card with an introductory 0% APR period for balance transfers will obviously save you money in interest. Those savings can add up to hundreds or even thousands of dollars depending on how much you owe. According to American Household Credit Card Debt Study, the average household with revolving credit card debt, that is, debt that was carried from one month to the next, had a total of $6,741 in such debt in March 2019. Let's say you had that much debt on a card with an APR of 17%, and you wanted to pay off the debt in equal amounts over 18 months. If you left the debt on the 17% card, you'd pay more than $900 in interest over the course of those 18 months. If you transferred the debt to a card with a 0% intro APR for 18 months, you'd pay no interest at all. Further, if you used the money you would have paid in interest and applied it to paying down the balance, you'd be out of debt a couple of months earlier. A balance transfer isn't always a slam-dunk solution to high-interest debt. Most cards with promotional 0% APR periods charge balance transfer fees, which typically range from 3% to 5% of the amount being transferred. Some cards don't charge these fees, or waive them for a period of time when you first open your account. Before pulling the trigger on a transfer, consider whether the amount you'll save on interest will be enough to make up for any transfer fee. In the above example, a 3% fee on a $6,741 transfer comes out to a little over $200, while a 5% fee would be about $340. If you're saving $900 in interest, then the fee is worth paying. However, if you've been planning to pay off the debt in 6 months rather than 18, then the transfer would have saved you only about $330 in interest. So a 3% fee would have eaten up most of your savings while a 5% fee would have ended up costing you money. Whether a balance transfer will save you money depends mostly on 4 factors. How much you owe. The current interest rate on that debt. The balance transfer fee. How long the 0% period on a new card lasts. If the math on a balance transfer works in your favor, here's what to do next. 1. Apply for a balance transfer card. In many cases, cards with an introductory 0% APR offer for transfers give you only a short period of time after opening your account to take advantage of the offer, say, 60 days. So even if you already have a card with a 0% period in effect, it might be too late to use it for a transfer. In general, you'll need good credit to qualify for a balance transfer card. Most issuers won't let you transfer debt from one of their cards to another. For example, you can't transfer a balance from one Chase card to another. So make sure you aren't applying for a card from the same bank that holds the debt you need to transfer. 2. Tell the new card's issuer you want to do a transfer. With some cards, you can do this from your online account dashboard or even the issuer's mobile app. With others, you'll need to call the customer service number on the back of the card. 3. Provide information requested by your issuer. You'll need to know the account number of the debt you want to transfer and how much you want to move. Depending on the credit limit on your new card and the card issuer's policies, which may limit the amount of a transfer, you may get approved to transfer the entire amount or just a part of it. 4. Continue making payments on the old card. This is critical. The transfer doesn't happen as soon as you ask for it. It can take days or even a couple of weeks. Pay at least the minimum until your old card account shows that the debt has been moved. The last thing you want is to incur an expensive late fee, and possibly damage your credit scores. 5. Watch your accounts. You'll see the debt paid off on the old card and show up on the new one. Now it's time to pay it down. 6. Stash the old card, but keep it open. It may be tempting to cut up the old card and cancel the account for the sake of catharsis, but closing a paid-off credit card account can damage your credit scores. If the card doesn't charge an annual fee, keep it open. You can pay off your debt faster. This should be the point of the balance transfer. Apply the money you save in interest to your balance to get you out of debt faster. Don't just move debt from one card to another to avoid paying it off. It simplifies your finances. If you're juggling multiple payments and due dates, you may find it easier to consolidate into one monthly lower interest payment. If you don't pay off your debt within the 0% period, you could be worse off. Without a solid plan in place to pay off the balance you've transferred, you could end up paying interest at even higher rate than on your previous card when the 0% period expires. There's typically a fee involved. Most cards have a balance transfer fee, and depending on how much you owe and the terms you're looking for, it may not be worth it to shift your debt. You need good to excellent credit to qualify. If your credit standing is just okay, you may not get approved for another card. And every time you apply for a new card, your score takes a hit, so it's best not to apply if you think approval is a long shot. You may get approved for an amount less than you want to transfer. The new card's issuer might let you transfer only a portion of what you owe. For example, it might set a limit of $5,000 on balance transfers. You can try asking for a higher amount. If that fails, consider other steps to pay down your debt and, go get that money.